We are broadcasting from beautiful St. Augustine, Florida, the nation's oldest city, at WFOY 102.3 FM studios. Through the power of the Internet, this program is being streamed worldwide on 1023newsradio.com. That's 1023newsradio.com. The show will also be archived on FirstTitleServices.com and TitleCompany.com, as First Title and Escrow, Inc., a leading national title agency, are the sponsors of this program. Additionally, this show will be posted on YouTube.com. Our radio show mission statement: to provide an educational experience for listeners in a promotional format for real estate sales across the country. We're going to be talking about real estate, different real estate markets across the country. We've got a lot of topics today to help us out. We've got several real estate leaders calling in today, one from Miami, Florida, one from the Detroit, Michigan area, one from South Carolina. Good stuff, very interesting topics. Let's go to our first caller. Good morning, you're on the air.
Good morning, calling for Doug Dennison.
Yes, Jay. How are you doing, sir? You're on the air.
Good morning, Doug. How are you?
I'm wonderful, and thank you for calling in. Jay, for our listeners, tell us again who you are, where you're from, and what do you do, sir?
Sure. Jay Massirman, Miami, Florida. We own and operate a company called Rivergate Companies. We are a multifamily manager of market rate and affordable housing, and also an investor.
Well, good. You and I know each other from past days when you were with CBRE, CB Richard Ellis. You were the top producer in Miami and in many areas for a long time. How long were you there?
I was there 20 years, Doug.
Wow.
I started as an associate in 1986. Sort of retired, if you will, as a vice chairman in 2007 to pursue, the building of an operating platform.
Well, nice. Tell us a little bit about South Florida. I've been hearing great things, but tell us about what's happening. It seems like a huge resurgence.
Well, I'll touch on different segments, Doug, because it's a diversified business. First of all, the condominium business has come roaring back. There was a time, I remember, in 2008 or 9 when nothing was selling on Brickell Avenue.
Yep.
Prices went from 1,000 foot to 200 a foot, and all of a sudden, a local real estate company called Fortune International had brought some foreign investors in, and they snapped up 320 units, starting at $200 a foot. And that sort of transaction started the resurgence. That was the first time we've heard in many years that, hey, something sold out in 2 weeks or a weekend.
Okay.
So all of a sudden, from that time on, the sites started trading, the inventory started burning off. There was 10 years worth of inventory, if you recall the numbers.
Yep.
That got burned off in a year or two. And then you saw there were some very interesting things, like the Related Group was a leader. In South America, Doug, a lot of times what they do is they get if the unit's worth $200,000, they basically a buyer commits to $200, and you get a series of deposits. I want to say 30% up front, so $60,000 down. They start the foundation, they close on the land, and then they go back and say we need another $60, and then the final payments, and so no construction loans.
Got it.
Amazing. So that has led the resurgence. Condo Vultures is a local newsletter. Peter Zalewski, who's just done a fabulous job. There's back up to 100 projects again in the condo side.
Wow.
So that's been amazing. The multifamily business, same thing. Cap rates were 8-9%. You could basically in 07, 08 buy whatever you wanted. Now things have gone, back to 5 caps, sub 5 for value add, Doug, and prices are trading at 30 or 40% above replacement cost in certain issues. So there's a huge push for cash flow and current cash returns now on the investment side in multifamily. Really created a big froth. The one fly in the ointment is the rise in interest rates.
Okay.
I think that Fannie and Freddie, which are the bellwether, financial multifamily, have gone up somewhere between 100 and 150 basis points. Now, that may fluctuate a little bit, but I think to a lot of folks it signifies a little bit that sort of slow climb.
Yeah.
And it has definitely put a monkey wrench in the process. The retail has come back extremely strong in South Florida, as well as industrial value-add office. So all the segments are strong, extremely strong, and we're experiencing a resurgence here, South Florida.
Well, I've heard, of course, the resurgence. I've heard about the condos, but I have not heard the story of Fortune International coming in and buying a lot of them, and basically someone has to do that to start the climb forward, else there's just a lull and deadness and nothing happening. And, of course, I remember all of those cranes, doing nothing on the Miami waterfront and Brickell, and it was really kind of eerie.
Yeah, well, it's official, Doug. The crane is back as the official bird of South Florida. And not to just mention Fortune, there's obviously many others.
Sure.
There's Sotheby's, there's ISG, there's, the related with their own group.
Yep.
You've got, several others. I don't mean to leave anybody out,
yep.
but, several competent groups. And what's happened, Doug, is we and I've had a lot of these conversations, we talk to a lot of foreign investors and a lot of folks that come from South America. And what you have there is you'll have unstable political regimes.
Yes.
Argentina, for example, is one that's going through this right now, and even Brazil. Obviously, Venezuela we know about, and several other countries. And there's a tremendous amount of wealth, family offices down there, a lot of the families that run the big companies down there, that there's large populations. There's a constant flow to Miami, specifically when you say South Florida. And really on the condo side, specifically Brickell. Brickell is gold. If you get off of Brickell, it means something different. Doesn't mean it won't do well. Maybe it has to be waterfront at that point.
Yeah.
But there's a lot of flight capital, tremendous amount of flight capital, which makes Miami specifically a very unique place to do business.
Well, tell me a little bit more about Rivergate Companies. You're the CEO. You've got a pulse on a lot of different things in Miami. You've been in the market for a great deal, long period of time. You know all the movers and shakers. What are you exactly trying to do?
Sure. Well, there's basically trying to emulate a couple of firms out there that are nationwide, that are in the business, Doug, of third-party management and investment and ultimately development of multifamily. I have been in the apartment business for about 26 years, as you know, 20 as a broker, 6 as a principal. I would say I have after 6 years of being in the principal business and surviving, that maybe is an MBA, but I would say it's a PhD from what I've been through.
It's a PhD.
Not to say no one else has been through anything more difficult. It's been a very difficult economy.
Yep.
A lot of major guys that maybe people never even heard about never even made it.
Yep.
Just liquidated, lost their homes. So it's been really a brutal market. There's been a lot of very, very intelligent capital out there that moved in very quickly for distress. I think there's still distress. It's ongoing, but it's just not as much. And now it's more about adding value. What we like to do, Doug, is we, myself and my team, we have 65 employees in the company at this time. Everybody's instilled with the philosophy that it's all about people. We work with people every day. We work with tenants, residents, vendors, investors. Everybody has to be treated right and fairly. We manage some very challenging, affordable housing, subsidized housing projects. We are proud to say we remain full. We have incredibly dedicated staff on those deals, and that operating ability, Doug, the ability to understand that and operate in diverse markets is making us a better buyer of apartments. So we like to serve other clients. We like to serve third-party clients. It keeps us in line. There's a lot. It's just solely accountability. If you're doing a great job, then you're just doing your job at that point. If you're doing a bad job, you're really going to hear from your clients.
Sure.
So it's a bit of a thankless job in a way, apartment management, but it's extremely rewarding when we do well. One big trend, Doug, in apartment management that's has become extremely prevalent, and I would say this is probably in the last 2-3 years, is leasing through the internet. And, whether it's a affordable housing project or it's a luxury market rate, which we have beautiful condo quality projects that we manage also in what we call our market rate division.
Yeah.
Same thing. People drive around. They land in Boynton Beach or they land in Orlando, and they just get on their smartphone and say, "I need an apartment, on 12th Street in Maine." And all of a sudden, 10 complexes come up, and they tap on their smartphone because smartphones have eclipsed PCs now.
Yeah.
And it's actually proliferating exponentially right now. So it's almost, I don't know what the number is, say 5 years. Maybe people aren't going to have a PC. They're just going to have an iPhone. We're going to surpass it, or a smartphone, an Android, whatever you want to call it.
Right.
So a lot of folks are just in their car. They're calling. So what we have is we have a somewhat proprietary program that essentially captures all of this traffic from Apartment Guide, Apartment.com, Rent.com, MLS, different websites, and Craigslist is huge.
Yes.
Craigslist, it only lasts for a couple of minutes. You post your thing, it gets ghosted quickly or off to page 5 because there's so many posts. We do blogging. We try and get the name out there. The residents call us, and we have a program that tracks them. We have a follow-up program, and we capture a lot of that traffic, Doug, that can get lost out there. And that's a little bit of our secret sauce that's made us very successful on the management side, keeping our apartment complexes full, and we see that as an ongoing trend.
Very interesting. Now, have rents gone up in the last year or two?
Yeah, rents have really come back strong. I mean, rents obviously nationwide, but in Florida, specifically in South Florida, they were down 20-30% in the mid to late 80s. They've come back very strong. They've come back to current market, and they've now exceeded.
Okay.
Because the demand is so strong in certain areas. Certainly around the universities, demand is extremely strong. The downtown areas, the resurgence, Doug. 5 years ago, walking on Brickell Avenue was a ghost town.
Yep.
Now you go there, there's teeming with life. There's strollers, joggers at 7, 8 o'clock at night, restaurants everywhere, in the lobbies of the buildings, all that retail space that was not able to be leased out. So tremendous phenomenon. Market very strong. There's a lot nationally, locally, regionally, tremendous amount of new construction underway for multifamily. The good news, bad news is that obviously it's adding a lot of new housing stock, good quality housing, mostly going to be very higher end, although there's certainly, tax credit and bond deals that are, create affordable housing.
Mm-hmm.
So the rents, that they need for new developments are very strong. And so, we're going to see $2.50 rents for luxury product, and those are approaching rents that they used to get in D.C. 2-3 years ago. Now,
right.
D.C. is probably, $4 or $5 a foot. And to give you a perspective, New York City can be, $7 to $9 a foot.
Crazy numbers, yeah.
Rent. So it's really on the high end. It's gotten pretty crazy, but it's good news for developers because the numbers work now. For affordability, it's a problem. It's a continued saga of not going to be enough affordable housing, and there's a lot of chinks in the armor right now with the federal government, with keeping the affordable housing programs going, the tax credit programs, Fannie and Freddie, they're looking to shut them down, where that is quasi-governmental, becomes private.
Right.
And that's been low interest rates for acquiring apartments and keeping rents low. And so there's some changes going on, Doug, that are gonna take are going to be very interesting and challenging going forward.
Now the downturn, obviously, a lot of people got hurt, and a lot of people ended up losing their houses. That means that they need to rent. Do you think that that's going to turn? Is it turning now that they might have got out of that problem and now are looking to buy? Or is it just the mortgages and trying to get that kind of money is too difficult, so you see a continued increase in renting?
Yeah, the single-family side is very interesting. The Wall Street has gotten into the single-family home business.
Yep.
Blackstone, BlackRock, number of different funds have been scooping up a lot of the inventory. And what's happened is basically that has bolstered the pricing in housing.
Okay.
Now, a lot of stuff they're buying is that middle market product.
Yep.
I looked at that segment, and maybe for right or for wrong, they sort of passed on it. To an aggregation strategy of single-family homes, and I got approached for management, and we have been looking at a few of those opportunities. But when all the houses are together in close neighborhoods, certainly easy on a maintenance standpoint.
Yes.
You don't have to maintain separate homes, so there's challenges to that. Wall Street, they sat around saying, "Hey, let's look at the numbers. We get big numbers here. We can throw billions at this thing. We can ride up. We can buy it $100,000. We'll sell it, $175. We'll make our multiples. We'll make our profits. Our promoted structures, etc." So it's been interesting where they actually competing against the product. Rates have gone up. That's put a little bit of a break on refinancings now. I just talked to a friend of mine who had a sort of a jumbo home, which is called $500,000 range. And 2-3 years ago, couldn't refinance it because the appraisals were not appraising. And now, 2 years later, been a lot more sales, a lot of financing. Rates were low for the last year. A lot of people refinanced. A lot of houses sold. Values have risen. He got refinanced, no problem. And so that underwater effect, Doug, time is solving it, but it's not organic solving, where the market's coming back on its own. People are buying hundreds of thousands of homes and holding them off the market. And so there's a little bit of an artificial support to that. So it's
are they holding, or are they renting, or are they?
They're holding and renting.
Okay.
And they're going to wait to probably resell either, I don't know, in bulk or in a one-off basis.
Okay.
At 3 to 5 years from now.
Okay. And I know a lot of them have been doing that. Do you think that is going to continue, or there's just not that much a volume anymore left?
Well, I've always seemed to be wrong about these assumptions, but if you apparently with Fannie Mae,
yep,
and a lot of the big banks and a lot of the big mortgage providers that went out of business early on,
yes,
First Nationwide, different things like that. A lot of the banks still apparently a fair amount of inventory,
okay,
that's in the full. A lot of short sales, floating rates have kept people alive.
Yep.
People that own their homes that just aren't paying.
Yep.
I know one situation where, obviously in the last cycle, people that were not qualified were given, $250,000 homes, and I'm just making it up,
sure,
say they were a domestic.
Yep.
But somehow they qualified and they got it. So, they get foreclosed on. Some of them had to file bankruptcy just to, get out of exceeding debts. And I spoke to one of those individuals, and they said, it's funny, they looked at the public records, and their name is still on there. So they've been foreclosed, but let's call it, Bank of America. It's not Bank
yep.
of America. I'm just using that
yes,
name.
I understand.
Their name is still on the deed.
Yep.
So how does that happen? Well, the backlog, the banks are sitting like, look, that's just unimportant to us right now. I mean, we'll get to that when we
yep.
get to it. So there's a lot of inventory. Again, Miami is very unique. The condo market, housing market. But look outside to Broward, Palm Beach, look at Orlando, look at Tampa, look at Pensacola, Tallahassee, Gainesville, Jacksonville, and then up to Georgia. And so look at all the sort of, Marietta, Georgia, that's high end, but so the southern part of, below Atlanta, more moderate income. You look at all those different areas, and there's still a lot of distress. Jobs, which is, certainly you could do 100 segments on, Doug.
Sure.
High tech and so forth. The jobs are different, are being created that are different now. Not that it's not just jobs are back and everybody's employed and we're all good. People are employing less, generally speaking.
Yep.
And with general employers, you have people that are doing the work of two or three. What 2 or 3 people used to do,
yep.
One person is doing now, and probably getting paid less than they would,
yep.
5 years ago. That's the reality of the working class today. Sad but true. Don't know what's going to change, and how we're going to get ourselves out of it. We focus on jobs. We see jobs going up. A lot of the jobs going up in the last few years were the corporations rehiring,
yep.
who they had laid off.
Yep.
So there's definitely still organic job growth. The economy, you can feel it getting better. We know it's getting better, Doug. Still a challenge.
It's a great interview with you always, Jay. How can people get a hold of you, because you're a wealth of information down there in South Florida?
Well, thanks, Doug. I appreciate that. We are actually just relaunching our websites within a couple of weeks. That is currently www.rivergatere.com, and the RE is real estate.
Right.
So it's www.rivergatere.com, and I can be reached at jay@rivergatere.com is my email address.
Very good. Hey, Jay, thank you so much for getting on the show, and you have a wonderful weekend. Look forward to working with you again, and my memories of working with you in several different big sales and for the federal government was great. You're always the true professional.
We had a lot of fun. I obviously think the same of you. We've known each other now too many years.
Yep.
We have to be careful how many years we say it, because it's going past 20.
Exactly.
Top flight professional, Doug. Always enjoy conversing.
All right. Take care, Jay. Have a great weekend.
You too.
Bye-bye.
Be well.
All right. That was Jay Massirman. We're coming up on a break, but I want to talk to you about the 5-Star Conference and Expo coming up on September 8th to 10th in Dallas, Texas. You want to go to 5starconference.com or call them at 214-525-6766. They are, I'm going to say, the best real estate and lending conference to go to. 4,000, 5,000 people each year go there. I'm going to go there again. We've got keynote speakers, Dr. Condoleezza Rice, former Secretary of State, Mrs. Laura Bush, former First Lady, Barney Frank, former U.S. Representative, and James Lockhart from W.L. Ross and Company. They will all be speaking. And on a lesser note, I will be speaking there. So I'm looking forward to it. And let's go for a quick break. Thanks. All right, we're back listening to First Title National Real Estate Radio. I'm your host, Doug Dennison. Let's go to our next guest. Good morning. You're on the air.
Good morning, Doug. Gene Pyatenko calling in.
Gene, thank you so much for calling this Friday. Hey, tell us, for our listeners, you and I have known each other for a long time, but tell us who you are, what you do, and where you are from, sir.
Thanks, Doug. Obviously, Gene Pyatenko. I'm a practicing attorney in Michigan, specializing in mostly commercial, banking, transactional work. I do some international practice in the former Soviet Union. I speak the language.
Wow.
And my partners at Evans & Luptak, Mike Mayer, Ed Darren, Sam Shimatero, and I have recently affiliated with the law firm of Plunkett Cooney, based in Michigan. We have 9 offices in Michigan and 1 each in Columbus, Ohio, with 160 attorneys and approximately 320 total people, including our staff, doing a multidisciplinary practice, primarily in the Midwest.
Well, I was up there, I'm going to say 5-6 weeks ago, something like that, and got a chance to see you again and meet your partner, Mike Mayer, in Plunkett Cooney offices, and seems like a great group. And I guess probably the excitement, or I'm not sure what the word is, but everybody's talking about the city of Detroit and the financial mess it's in, the largest bankruptcy. Tell us what is happening. Give us an update on that, sir.
Well, sure, Doug. It's first. Let me say that this has been building for decades.
Okay.
This is not an overnight issue, and it's the largest municipal bankruptcy. They call it a Chapter 9 filing, which is a subsection of the bankruptcy code that allows municipalities and governmental entities to file for effectively a reorganization. And the concept behind it is to get all of the various constituents in one forum so that you're not involved in piecemeal strategy under one roof to figure out how do we get from where we are today to becoming, again, a more vibrant, fully functional, effective city that takes care of its citizens as well as the business community. We have a lot of exciting things happening in Detroit in terms of the ball teams. The Tigers are leading the Central Division.
Yep.
And we've got the Lions that have some prospects. The Red Wings everybody knows about.
Sure.
But as far as the bankruptcy itself goes, we have some administrative hearings being held as we speak. They started at 10 o'clock, and it's a status conference before Judge Rhodes here up in Detroit, in the Eastern District of Michigan. And not much substantive is going to occur today, but it really is a menu or a recipe for how things are going to proceed. The judge is going to address who is going to represent the various constituent groups, the retirees, the union, and the like. There are over 100,000 creditors.
Wow.
In this bankruptcy, and it includes bondholders, secured creditors, unsecured creditors, vendors, employees, and the like. It's a big task, but I think we Detroiters are up for it.
Okay.
In general, there are a lot of good things happening.
Tell me about downtown. I've heard various things that's turning out to be an exciting area. The properties are being bought up. There's retailers coming in. I mean, there's some good stuff happening.
Well, there are a number of businesses are coming into town. They're relocating some of their headquarters, bringing jobs to the downtown area. One of the challenges has always been, and I'm talking about decades worth of challenges,
sure,
is that starting back in the 20s when various groups ventured out into the suburbs, Troy, Birmingham, Dearborn, Highland Park, Sterling Heights, etc., a lot of diversification happened so that the city center, unlike some other cities where the financial district remains concentrated in the downtown area, we've had some of that spread, or sprawl, as you call it.
Yep.
The other issue that we have, and this to me is one of the greatest challenges of this bankruptcy and the rejuvenation of Detroit, is going to be how do you deal with 143 square mile territory, which is the area of Detroit, and how do you service that from an infrastructure standpoint? The population of Detroit, well over 1 million, has now shrunk to 600 or 2 million, has shrunk to 700 some odd thousand. You have a lot of vacancy, a lot of available property, but that also presents an opportunity, by the way.
Sure.
And it'll become an issue of how to reconcentrate and how to properly service. I understand, everybody understands the challenge of how do you run power lines and water infrastructure to a neighborhood that may only have one house remaining from what it used to have 5, 10, 20, 30 years ago. So in this reorganization, part of it is going to be, I think, a challenge is going to be contraction,
okay,
or reconcentration, and then redeployment of the assets, meaning the property, the vacant land that can be converted into other uses. There are going to be some challenges.
Well, you and I worked on a auction for the state of Michigan where we sold a disbanded state psychiatric hospital, and we sold it for $31 million. Is that going to be part of the things? Are there properties that aren't being used and need to be sold, and so other people can come in and buy them and pay taxes? Is that a possibility, or is that really a different area?
No, I think you hit the nail on the head, Doug. I think in order to reconcentrate and make the city more efficient, I think there will be some property sales, whether they're in the central business district or whether they're on the perimeter.
Okay.
A number of properties need to be sold, frankly,
yep,
and redeveloped, and whether they can be moved to adjoining communities. But the tax base, because of the population decline in the city itself, you can't solve this problem by taxing the people that are here more.
Right.
We do have to spread the tax base around and increase the base itself while maintaining a competitive tax rate. The interesting parallel, and I don't necessarily want to tip my hand one way or another regarding what's happening in Washington,
right,
but that's at least a part of the problem. Mm-hmm. Everybody recognizes that we need some revenue. Everybody recognizes that we need to cut spending. But raising taxes has never been the answer. You need to create more taxpayers,
yep,
not tax rates.
Yep.
And that's going to be probably one of the largest challenges, Doug, here in Detroit. And as you and I have worked on that psychiatric hospital, I think there's going to be more and more of that. Given the complexity, I don't believe traditional real estate traditional real estate transactions will not necessarily be the answer, although there will be some.
Right.
The auction process makes a lot of sense because it will generate interest with your group that we've worked with its national as well as international reach.
Sure.
I think it's going to take that type of a marketing effort to shine a bright light on Detroit in a positive way, as opposed to the negative press that it gets more often than not.
Well, you know, I have been to Washington several times, trying to kick somebody to make something happen, and it's so slow up there, and politics is so slow. But they've got, you know, basically thousands of properties that are surplus, and they actually spend, according to GAO, $1.6 billion just maintaining those surplus properties, and those need to be sold. They need to be sold and revenue coming in, and more importantly, instead of a property that you're paying out on, and when I say we, it's the taxpayers, now you get somebody that buys it, has a dream for it, is a taxpayer. When they take an abandoned surplus property and then start to create jobs and buy services and plumbing and electrical and again hiring, that is all good stuff, and you can't pick on just the federal government, because every area, whether it's county, state, city, and of course we're talking about Detroit right now, has surplus property that they're not using and actually spending money maintaining, and every month that there's a property that is abandoned is going down in value. It's being vandalized. It hurts all the other areas, and you know that. So that's my speech for you who know it very well. But you got to sell those things that aren't being used.
Well, Doug, you're so right on this topic, and the positive, at least the business community, and I think the majority of the citizens in Southeast Michigan, and particularly in Detroit, understand that, and the bankruptcy process, and hopefully it will continue to be effectively administered, is one of the best forums to bring all of the assets, all of the players, all of the interested parties essentially under one roof.
Yeah.
The sporadic hit and miss without this type of a process just makes it more difficult.
Yeah.
It makes it more difficult. You have divergent interests that while certainly everyone's ideas and thoughts need to be addressed, it's difficult. It's virtually impossible to solve the problem if you're spattered all over in various courts or various venues.
Yes.
And various processes.
Well, a huge job. It's going to be very interesting. I know you're in the middle of it, and I want to thank you so much for being on the show, taking time out. I look forward to coming back up there again and having dinner with you, maybe seeing a Tigers game, and again, working with you in the past has been very, very nice and very productive for the state of Michigan, and hopefully we can work together again. How can people reach you, please?
They can reach me at my direct dial is area code 313
Okay.
983-4975. Our firm's website is www.plunkettcooney.com. That's spelled PLUNKETTCOONEY. I can be emailed at E, as in Eugene, Pyatenko, PYATENKO, at MSN.com.
Well, Gene, again, it's a pleasure to have you on this Friday. Enjoy the weekend. Go Tigers, and thank you again for being on the show, and look forward to coming back up there and seeing you.
Well, I look forward to it, Doug, and it's always been a pleasure working with you as well, my friend.
All right. Take care now.
Thank you. Bye now.
All right. That was Gene Pyatenko, a attorney up in Michigan. Let's go for a quick break.
First Title and Escrow is a national leader and pioneer in the title industry. The firm specializes in title insurance, title examination, property information, escrow services, and other management solutions in more than 40 states. Their residential and commercial real estate experience includes work with government agencies, asset managers, banks, auction companies, developers, portfolio buyers, real estate firms, and the private sector. To contact First Title and Escrow, please call 866-484-8537 or visit FirstTitleServices.com.
All right, we're back listening to First Title National Real Estate Radio. I'm the host, Doug Dennison. We are broadcasting from the nation's oldest city, St. Augustine, Florida, at WFOY. And I thank everybody for listening. Two wonderful guests, Jay Massirman, CEO of Rivergate Companies, and Gene Pyatenko of Plunkett Cooney up in Michigan. So the Detroit bankruptcy in the city of Detroit, that really interests me, of course, because I've done work up there and just was up there 5-6 weeks ago. Our company has a branch office in the Detroit area. Again, that's First Title Services, and we can be reached at firsttitleservices.com or titlecompany.com. Going back on DS News, the 5-Star Conference coming up. That is on September 8th, 8 to 10 in Dallas. The 5starconference.com website. Go on there. Everything is on there. Or if you want to call them, it's 214-525-6766. They also put out a magazine and also a website that you want to go to. It's dsnews.com. dsnews.com. There is a thing called the Daily Dose that will end up giving you an email. If you're in this business, if you're in real estate, if you're a lender, you want to be on this email that's free. You've just got to sign up on it. And again, you go to dsnews.com, and it's called the Daily Dose. You sign up for it, and they do basically the biggest and best articles of the day that come out. I just got a DS news alert. Says payrolls up 162,000, unemployment rate down to 7.4% in July. It says the nation's economy added 162,000 jobs in July as the unemployment rate fell to 7.4%. Good stuff. You want to go on it, dsnews.com. Let's go to our next caller. Good morning. You're on the air.
Good morning, Brad Thomas.
Well, Brad, thank you so much for calling, and you are a weekly caller, and I'm so excited to have you on the show because you are a unique skill set in the real estate business. Tell us who you are, what you do, and where you're from, sir.
Okay, well, today I am, again, driving in my car. So I'm in South Carolina today. I got in last night.
Okay.
I was in New York this week. I'll tell you a little bit about my meeting this week. But I work out of Atlanta with Bull Realty and in the capital market side of the commercial real estate business. So I work primarily with institutional investors and REITs as well as private equity funds and high net worth investors to help them in acquisitions and dispositions on a lot of properties, primarily single tenant net lease properties.
Well, you are the man as far as REITs, and I know I ask every week to say what a REIT is because, again, we have the general public on this show listening and people that really don't know anything about it. So a quick summary, what the heck is a REIT?
Sure. A REIT is a real estate investment trust. REITs were formed in 1960 when established by Congress, part of the Cigar Act, which was during the Eisenhower administration. And so REITs have been around for over 5 decades. It's not a new asset class. What's interesting today is that you're seeing a lot of new REITs enter the sector, and a lot of new sectors that we've never seen before, like data storage and like life science. There's actually a prison REIT now, potentially gaming REIT. So what we're seeing today, Doug, is in the REIT world is basically anything that has a real estate function.
Right.
I'm looking at a billboard right now, and there's actually 2 companies, Lamar and CBS, who have announced they are considering converting to a REIT status. So you're seeing a lot of new space. So it gives the individual investor, access to practically any asset sector today.
Okay. So if they think that one particular sector might be going up, they could go to a REIT rather than one particular property. Is that it?
Yeah, that's right. I think what's really driven the companies today that are non-REITs to convert to a REIT is simply because it really boils down to the demand for income. And so a lot of companies today can see that the stocks are trading at pretty high multiples. I wouldn't say that REITs are extremely expensive today. I would say that they are fairly valued, but they are fairly valued because investors enjoy that dividend income. REITs by law, Doug, are forced to pay out. One of the biggest tests for a REIT, or not a test, but actually a law, I should say, is that REITs are forced by law to pay out 90% of their taxable income in the form of dividends. So non-REITs don't do that. You invest in Colgate, Palmolive, or Coca-Cola, or any of these, Home Depot, any of these companies, they certainly pay out dividends, but they don't have to pay out dividends.
Got it.
And so with REITs, they have to pay out dividends. That's why they do pay out higher dividends than non-REITs because of that forced component.
Got it. Now, you just returned from New York. You go up there, you have meetings, you have interviews, you write for several different companies. Tell us who you write for, first of all.
Sure. Well, I write for Seeking Alpha. That's kind of my daily grind.
Mm-hmm.
And also, I've been writing a lot with The Street, which is a lot of people may associate that with Jim Cramer, who obviously is very actively involved with The Street.
Yeah.
And so I'm up there very regularly. I'm writing a column now called REITs on the Street, which we just started. But so I'm writing a column on the website, as well as I'm doing more videos. In addition to that, I've also written for Forbes and a few other online publications as well. I love the online publications because it's a good way for me to reach out to literally thousands of readers today. So, about 2 months ago, Doug, I started a newsletter. Basically, I had a lot of readers ask me to build a newsletter product. So
right.
I launched that about 2 months ago, and it's going very well. And that newsletter is called The Intelligent REIT Investor, and that is you can find that on my website, which is The Intelligent REIT Investor as well. And we're selling that newsletter for $99 a year. It's based on we're focusing on individual investors and REITs today, and we've got a lot of good high quality information. I've got the August newsletters going out the first of next week.
Well, according to your website, and you've got some great fans on there. Donald Trump is one of them, saying your newsletter is a great source for investors today. Other top people in the business world, but $99 sounds like a big bargain, sir. So what is your website one more time?
Sure, it's www.theintelligentreit.investor. And again, we'll focus every month on a sector. I have one section called the Blue Chip REIT of the Month. So
okay.
There's quite a few what I consider blue chip REITs as well.
Okay, and again, tell us about your trip to New York.
Sure. Yesterday I had my fourth or fifth meeting with Donald Trump.
Wow.
And it was an amazing time. It seems like every time I go up there, I learn so much, and that's really what I enjoy with my relationship with Mr. Trump. He certainly has mastered the real estate world. He's now, he's beyond a U.S. brand. He's a global brand. He was actually in the process, when I saw him yesterday, of closing a pretty sizable deal. Very, very active in real estate. And, you've probably seen some of the articles that I've written on some of his projects as well.
Well, that's excellent. Any kind of tip of the week that you want to tell our listeners?
Sure. I think we're seeing a lot of earnings coming out this week. That's what I'll be busy doing today is checking on some earnings. But overall, REITs have performed very, very well. And specifically, one sector that I'm writing about a lot,
okay.
which is really my wheelhouse, is a single tenant of the triple net sector. We've seen Realty Income came out with their earnings earlier in the week. National Retail Properties, WP Carey, I think, is coming out today or next week. But you're seeing a lot of growth, an enormous amount of growth in that sector. And that's really what's driving these companies today is the external growth and the amount of acquisitions that we're seeing in the marketplace today. Realty Income sourced $15 billion of assets in the second quarter. They closed on around just under $800 million. And that really drives the stock growth. So some of those names that I enjoy writing about, Realty Income, National Retail Properties, WP Carey, American Realty Capital Properties, their earnings are out next week.
Mm-hmm.
So those companies, I would really, if I had to pick one sector for an investor to own in a portfolio, I would say the triple net sector. It provides a very safe. These are long-term contractual leases, so it's a very safe asset sector. And you're seeing just a significant growth today.
Brad, I appreciate the tip. Give us your website one more time.
Sure, www.theintelligentreit.investor.
Very good. Hey, thank you, sir. And again, people, buy that subscription. Great value. And Brad, thank you so much for being on the show again.
You bet. I enjoyed it. We'll talk to you next time.
You bet. Bye-bye now. All right. That was Brad Thomas, CEO of the Intelligent Wheat Investor. Also thank Jay Massirman, CEO of Rivergate Companies in Miami, and also Gene Pyatenko, an attorney from the Detroit area, talked to us about the Detroit bankruptcy. Fascinating stuff. I thank you all for listening. We will be back next week, and have a wonderful weekend. Bye-bye.